In this video, we'll dive into Section 6 of the RPA, Additional Financing Terms, one of the most critical parts of the RPA that ensures both the buyer and seller are on the same page about how the purchase will be funded. This section sets out three important verifications. 1. The buyer's down payment and closing costs. 2. The buyer's loan application and pre-approval. And 3. The buyer's stated financing terms that the seller relies upon when accepting the offer. You'll learn step by step how to explain these clauses to your clients, what documents are required, and how to stay in full compliance with CAR's timelines under paragraphs 3H, 2, 3H, 3, and 3B. By the end of this lesson, you'll understand exactly what evidence of funds and loan verification are required, how to avoid common pitfalls, and how to protect your buyers and sellers during the financing process. Section 6A, Verification of Down Payment and Closing Costs. It is a written proof the buyer actually has the funds for the down payment and estimated closing costs. The buyer or the buyer's lender/loan broker can provide it, as allowed by Section 6B. It is due within the time stated in Section 3H2, the delivery's timeline. The acceptable documents are 1. Recent bank/asset statements with buyer's name. 2. Gift letter plus donor proof of funds, if applicable. 3. Proof of liquidation for stock/crypto/retirement or lender's DU/LP asset verification printout. 4. Lender letter specifically confirming verified assets for down plus costs. Section 6B, Verification of Loan Applications. It is a letter from the buyer's lender or broker confirming the buyer has applied and is pre-qualified or pre-approved for each new loan named in Section 3, and it is due within the time in Section 3H3. If Section 3E specifies an adjustable rate loan, the pre-qual or approval must be based on the qualifying rate, not the initial teaser rate. This matters for DTI/ability to repay. The pre-qual or approval letter should say, 1. Buyer has submitted a written application and credit was reviewed. 2. Loan product and type match Section 3E, for example, conventional 30 years fixed, 5/6 ARM, FHA, VA. 3. Estimated loan amount, LTV, and that assets/income were reviewed to that program's standards. 4. Any program-specific conditions, for example, VA COE, FHA CIVRS, condo approval. Remember to match the loan type in 3E exactly. If buyer is changing products, update the offer or disclose in writing. For ARMs, confirm the qualifying rate used. Ask for it in the letter. Section 6C, Buyer Stated Financing. The seller is relying on the buyer's stated financing, cash versus loan, percentage of down payment, contingent versus non-contingent. The core rules are 1. Seller agreed to a specific closing date and price in reliance on that financing. 2. Buyer must pursue that stated financing, even if they also explore alternatives. 3. Seller has no duty to cooperate with any different financing that could delay/jeopardize closing. 4. Buyer's failure to get an alternate loan does not excuse performance. Closing is still due on time at the price agreed, per close of escrow date Section 3B. Practically, you can shop for a better loan, but you can't let that side quest delay the escrow. If switching programs, for example, conventional to FHA, VA, or DSCR, get seller consent early, some programs add conditions, repairs, condo approvals, appraisal overlays that can slow or endanger close of escrow. Remember, if buyer wants flexibility, build it into Section 3E or add an addendum clarifying acceptable alternates. Document any program change promptly and address timeline impacts in writing.